Alright everyone, Cowboy Trades here, welcome back to the channel for another update. So I'm going to be gone for the next 5 days like I talked about in my most recent videos. So this morning I'm just trying to get a few quick updates out, and I do want to give you a quick update on the higher time frames for the S&P 500 2008 fractal. And also quite a lot of you have been asking me, what are my thoughts on the DXY? Am I still bullish on the DXY pushing up higher? So I'm just going to make a quick video talking about the higher time frames before I do head out today. So let's start off on the higher time frames, talk a tiny bit about liquidity conditions, and also talk about what we've been predicting for a while. So if you've been watching the channel, if you're a veteran, you'll know for the past 2 weeks or so I've been warning you that the markets are about to nuke. This was 2 weeks ago, and as you can see, we poked our head above this trend line since the video and then absolutely started to nuke to the downside, just like we were warning you about. Now, in terms of liquidity conditions, what's worrying if you're a bull right now is, yes, price action has started to push to the downside, but there's still a decent amount of quantities in bid and asks for the market. So at this moment in time, liquidity conditions, even as of yesterday, are super overextended. The mid price hasn't really started rolling back down into new lows, let alone coming back down and retesting the floor down here, let alone coming down and making, lower lows, lower lows, lower lows, lower lows, like it has done after each one of these peaks in liquidity conditions. I'm going to fly through this because I've talked about this quite recently. If you're a veteran of the channel, you know that these blue lines over here correlate to the peaks in liquidity conditions for the S&P 500, and every single time, without fail, we really start nuking to the downside for the markets. Now, for the Heikonashis, these are absolutely no joke. You can see most of the time, once you start topping out, the breakdowns last for a significant amount of time. In fact, you can see over here, this was approximately a 49-day drop. Over here, this was a 42-day drop before, of course, a bounce and breaking back down lower. I'm just looking at how far we can travel to the downside in a very one-directional way, not focusing too much about, we broke down, bounced up, and then broke lower, just how long we can go down in basically a straight line for. And over here was about 56 days. So I'm ill right now. I don't really want to do too much maths, but this is probably approximately about 45, 46, 47 days approximately that we drop after switching red. So we can definitely see definitely into Q1 of 2023, this bleed out, which I've been talking about. If you do watch the channel once again, we talked about another traumatizing event, wrapping up the year with, more traumatizing economic data. And I do believe this is going to bleed us into Q1 of 2023, mainly because we don't have much economic data until January. And we also don't have our next Fed meeting until February. It's another 43 days away. The next Fed meeting is on the 1st of February, where they will be discussing the interest rates, or, of course, FOMC meeting there. They will be amending the interest rates. Like I said, just a bit under the weather right now, so do forgive me while I do run through this. But all in all, S&P 500 liquidity conditions are still overextended, and I do believe we're going to continue getting a meltdown from this. Another way of flipping this is the fact that we talked about quite recently. You can still see in the weekly time frame, or daily time frame rather, you can still see the same trend line that we came up to. We didn't poke our head above this on the S&P 500. We did on the mini futures. S&P 500 is more important, however. We just look at the mini futures because they're open more often than the S&P 500. So you can see nasty bear flag. We broke down and we filled. Yeah, we actually filled this first price gap that we talked about in one of our most recent videos. But, since this bear flag, we broke down, retested the trend line, double topped, confirmed the bear flag breakdown, and now we're starting to head to the downside. And you can actually see since we talked about this video, we were predicting about an 18.8, 19% drop for the S&P 500. We've started to melt down a little bit. Well, not too much. We broke down about 4%. That's a big amount for the S&P 500, though. I do predict us breaking down probably about another 16% into Q1 of 2023. Maybe the next FOMC meeting, if they raise by 50 basis points again, that will be, so let's say we lollygag down here into, February, get that 50 basis points, and boom, come down to this price target. It's not anything for the immediate short term. It's really for the next 2 months or so, in my opinion. But with this, you can see nasty bear flag breakdown, and also the 2008 SPX fractal. They're finally starting to snap back. We talked about this, and when this was pushing up a little bit higher than it did in 2008, we were telling you that this was probably not going to last too long. And you can see, just look how beautifully. Bear in mind, we have retroactively fit the top, so we're not considering this data point. We align the tops ourselves. But after then, you can see this this trough was beautifully called. We poked up over here, it called a peak, and in the macro time frame it lined up very, very well, off by a few weeks, but in general macro peaks and troughs lined up very, very well. You can see over here 2008, the trough down to new lows, beautifully lined up with what happened over here. You can see the peak lined up beautifully, the lows lined up beautifully, and over here we did talk about, the chance that we might lollygag here for a while. In fact, it was round about November that we said, hey, the S&P 500 basically says that we're going to chop to the side for a month or so. I remember talking about that maybe round about 7th of November, early or late October rather. And we did push up a little bit higher than both myself and the S&P 500 2008 Fractal predicted. But in the macro time frame, once again, you can see, these troughs and peaks are beautifully playing out, and just look what is predicted what is next to be predicted for the S&P 500 according to this 2008 fractal. It is definitely not looking good at this moment in time. Now the monthly time frame as well. Monthly time frame has a nasty bearish engulfing candle. Over on the Heikonashis, we haven't actually yet started to flip back bearish, so once again another signal that we might have a ways to go to the downside. 3-month time frame, yeah, we're still in a higher time frame dead cat bounce after this reversion to the mean, so we've got a lot lower to go to the downside in my opinion. 6-month time frame, we've got indecision in the markets as we are, we had a bearish engulfing candle, now we're showing indecision and it's looking like we're going to roll back down. 12-month time frame, almost a bearish engulfing candle. I definitely think we're going to finish the year on a bearish engulfing candle, so 3,764. I do see us below this by the end of the year, which really isn't too far, for the S&P 500. This is only about another 1.5%, maybe 2% drop or so that I would be predicting for the final 2 or 3 weeks that we have left in 2022. So just a quick update on the 2008 fractal. Let's also do a tiny update on the VIX. I have got a video scheduled to upload. Actually, it should be out now. Yeah, it's just uploaded where I talked about the VIX, so I'm going to spend a tiny amount of time on this. Basically, 2008 VIX Fractal predicts that we're going to take a massive run to the upside right now. If we come over to our NASDAQ 100, NDQ, here we go. NASDAQ Fractal as well, it really lines up with economic data more than it lines up with the price action. But you can see the NASDAQ is predicting for us to break down into new lows at this moment in time. I believe that's pretty much all the fractals that we do look at. We also sometimes look at the Dow, although I'm not too interested in the Dow. You can see what's interesting is a lot of the peaks here lined up beautifully, the lows here lined up beautifully, the peaks here lined up beautifully, the lows here lined up beautifully. We definitely had a huge run up on the Dow, which was not what happened in 2008. But you can see in general, if I just kind of move this up, this kind of top formation dripping down into new lows looks very similar. So I'd say this was a big divergence from the Dow that we've just had, but as we've been talking about, these 2008 fractals have been playing out pretty well, and these divergences don't tend to last too long. So all in all, most of these look like they're getting ready to melt to the downside, and in the higher time frames, your S&P 500 weekly time frame, you can see for the money flow index, we are getting pushed and squeezed underneath this level while we're struggling to find, can't revert back to this, while we're struggling to find liquidity to even come back up to this trend line. And this ties in with the fact that liquidity conditions are already topped out for the greater market. So, we really shouldn't be doing anything apart from breaking down into new lows. The stochastic RSI is starting to flip bearish for the stock market. The last time it flipped bearish was when, all the way up here, 4,347, and we started to nuke down into new lows. So stochastic is looking bearish, MFI is looking bearish. Right now, the squeeze momentum indicator is technically bearish, but it's more neutral than bearish because it's returning to the heart line. You can see since October, it's just been coiling up, returning to this heart line. And when we do get ready, once we do start picking up momentum and starting to really shift down into the end of the year and Q1 of 2023, I do believe the squeeze momentum indicator is going to absolutely start yanking us down to much lower levels. So all in all, the stock market in the higher time frames is looking very diabolical. Like I said, I'm literally going to be leaving very soon, so I don't want to do too much analysis. So I don't want to do any analysis on the lower time frames. I'll do that when I get back. Like I said, I'm going to be gone for the next 5 days, but a quick update on the DXY. A lot of people have been asking me, do I think the DXY is topped out? And in my opinion, I don't believe the DXY has finished making its moves. I still do believe that, you know, even if the DXY comes up, you know, I'm not saying that this wasn't the exact top, because I'm saying that either we have a tiny bit further to push up, 121 is still a target I've got my eyes on, or there's a possibility that we could bounce up and do something like this and come up and double top, and you could see, if this scenario kind of takes its time into April, May, we could definitely line up with that Q2/Q3 bottom that I've been talking about on the channel for the past few days. If you know, maybe the past week or so, if you do watch the channel, you'll know that for the past few months or so, I've been saying for months and months and months now that I believe that we bottom in Q1 of 2023. And quite recently, I took that back because, you know, it's going to take a while for the interest rates to come down. Like, it's just... interest rates are at such elevated levels, and we've looked at how financial conditions affect the market. It takes a very long time. Even if the Fed pivot in February, we're still at extremely expensive monetary conditions. There's not the required liquidity. There's not enough incentive to go out and borrow money from banks to create more capital flowing into the markets, which is what is required for economic growth. So either way, what do I think is happening for the DXY? I think we're going to come down to this trend line and take a huge bounce up. We could either double top and then start heading down, or we could come up to this price target, and then I do believe that the DXY is topped. I don't think the DXY is far from a top. However, I can't be bearish on the DXY while we are coming down to this macro trend line, which has been in place since the 17th of May 2021. If we look at this, you can see this uptrend has been in play for 588 days, and if we do come down to this level, you can also see previous touch points over here, 103. If we zoom out, you can see touch points here, 103.8, which we are kind of lollygagging at right now. There's just so many touch points, there's so much support. As we do come down to 103, yes, could we come down to, you know, 102, 101 and then start pushing back up? It is a possibility. It would be a worrying sign, but really, as long as we stay above 103, I do believe that the DXY is extremely bullish and is definitely likely to continue its ascent to the upside into next year. I'll keep you updated if my thoughts change, of course. As you know, as soon as I do have a change in opinion, I will get a video out very quickly. I just haven't updated the DXY because there's... my opinion hasn't changed. I still do believe that, these areas around here, 103, is going to be a great place for a big bounce to ensue. So all in all, liquidity conditions are topped out. We don't have any important economic data coming in until January. We don't have a interest rate decision until February. And looking at how this has previously worked out, when you come up to the mean trend line, when you top out in terms of liquidity conditions, you're probably likely to get much more continuation to the downside. So I see us breaking down for the stock market in a very linear downtrend fashion on the weekly time frame. Bear in mind, this doesn't mean that on the daily we're just going to go down in a straight line. It does mean that on the daily time frame, it's going to be down, a tiny bit up, down, a tiny bit up, down, a tiny bit up. But on the weekly, it's more or less going to be pretty linear to the downside, in my opinion, week over week. I do see us continuing to melt to the downside, and there's a lot of price targets that we've mentioned. Price gaps that need to be filled at let me just double check. Yeah, there's a price gap that needs to be filled at 3,607, and in the immediate short term, until the rest of the year, I do see the S&P 500 coming down to this price target. That's another 5.5% drop into the end of year. So all I've got for you for this video, my friends. As always, if you do enjoy the content, make sure to let me know by leaving a like down below. Share the videos with your friends. Leave a comment if you want to. It's been your boy Cowboy Trades. I'm out. Peace.